Fannie Mae just made changes that may help you qualify for a home loan, and we're going to get into it right now. Hey everybody, Dietric Williams, realtor with Compass, Baldwin Hills, California. Welcome to another edition of Info on the Go, the show where I give tips, tricks, and insight on how to buy, sell, or invest in real estate in Southern California. If that sounds like something that you're interested in, please make sure you hit that subscribe button and tap that notification bell so that you're updated every time I upload new content to YouTube. Now, before we get into all of this, you're probably thinking, Dietric, what in the world is Fannie Mae? So let me just give you a very brief background on the organization. So back during the Great Depression, there were a lot of banks that closed, and that's because they had a lot of defaulted loans. About 1 in 4 people lost their homes in foreclosures, and they had a lot of bad stock investments. So those banks went belly up. Because of that, the banks didn't have money to lend out. So the economy went through a tanking process. Sound a little bit familiar? Yeah, it's kind of familiar. So in response to the Great Depression and all the stuff that was happening thereafter, Congress responded by instituting the Federal National Mortgage Association, better known as Fannie Mae, in order to provide some funding to help people really get into housing and spur the housing environment. Now, they brought a new type of loan to the program. It was a long-term fixed rate loan, which you could refinance at any time during the course of the loan. That had really never been done before. So now you kind of have a brief synopsis on how Fannie Mae started and what it does. It's really to help provide affordable housing to everybody who can take advantage of it. Now, what does this mean in terms of what I'm talking about? Well, I'm glad you asked. So Fannie Mae just changed its credit scoring qualifying requirements. Now, let's kind of look at how they used to do it. Everybody knows, or at least you should know, that you have essentially 3 credit scores. One from Equifax, one from Experian, and one from TransUnion. And when you go to qualify for a mortgage, the lender is going to pull all 3 of those credit reports, what they might call a tri-merge report, tri meaning 3. They pull the tri-merge report and they look at what's called your middle or median score. So let's say, for instance, you have scores of 650, 680, and 700. The lender is going to look at the median score, which is 680. Yep, that one that's right there in the middle. Now, if you're going to qualify for a mortgage with somebody like a spouse, partner, or family member, something like that, they're also going to look at that person's median score or middle score. So let's say, for instance, they have a 580, a 610, and a 650. They're going to pull the median score for that one and take the 610. Now, how Fannie Mae used to do it is they would take the middle score from you and the middle score from the borrower, and they would take the lowest of the two. In this instance, that lowest middle score would be 610. So in this instance with the 610, guess what happens? You would not qualify for a Fannie Mae based loan because the minimum credit score requirement is 620. That would push you right out of contention for that type of loan. But all is not lost because Fannie Mae changed the requirements. This is what this video is all about. This is great news, right? So in this instance, what Fannie Mae has done is said, we'll no longer take the lower of the 2 median scores. We're going to take the average of the 2 median scores. So they would take the first borrower who had a 680, the second borrower who had a 610, and they'd average those scores together for a score of 645. Guess what? You now qualify because remember I told you the minimum credit score requirement for a Fannie Mae backed loan, 620. So this is great news for people who are working on clearing up their credit, who need a co-borrower but need somebody that may be a little bit stronger in order to qualify. This is great news for them. The caveat to all of this remains to be seen, right? Because we're dealing with an inventory and a demand issue. We got a lot of demand, but not enough supply or not enough inventory. So seeing that when you combine Freddie Mac and Fannie Mae and what they account for in terms of mortgages, it's like 70%. So we're gonna see increased demand come from this, possibly, right? So that increased demand is going to possibly drive up prices because we still don't have inventory. And if you know anything about economics 101, when supply outpaces demand, prices fall. When demand outpaces supply, prices rise. So for those of you who can take advantage of this right now, you probably want to look at getting in sooner rather than later, because if prices continue to rise, it's going to push some people out of the market and the changes won't really make that much of a difference. But all of that remains to be seen, and I don't want to be the Chicken Little saying the sky is falling. The sky is falling in this video, but I do like to look at the numbers, and I just want to put that out there so that you can be well equipped and well informed to know what could possibly be coming down the pike. So just keep that under your hat right now, all right? So I hope this helps, guys. Huge changes from Fannie Mae. If you can take advantage of it, go out there and take advantage of it. Until then, leave me a comment below. Let me know what you think is going to happen in the real estate market with these changes, or whether you think this is a good thing or a bad thing. It remains to be seen. Between my colleagues and I and a lot of economists, we're kind of up in the air about whether this is good or bad, but I'd really like to know what you think. So leave me your comments below.